Christy Fontanilla of FAS Bookkeeping and Tax Services, and welcome to another video that I have created with small business owners in mind. So, this topic is real world bookkeeping 101 for small businesses. So, a few basics and a few things you probably didn't know. So, what I will cover on this video is the key financial reports, performance analysis, trends to watch, the process, checklist for success, and the business dashboard. So these are the things that we need to be familiar as a small business owner to be successful in managing our business. So what I have found in dealing with a lot of business owners on a regular basis is business owners don't know when they are off track. For some business owners, they don't really know when they are off track. Opportunities go unnoticed, which is really not a good thing for small business owners. And the markets fluctuate, and it's hard to really look into that wave when you're not looking, right? It's hard to see that or identify those when you're really not looking hard. Now, let's just go back to the fundamentals. So the first one here is the chart of accounts. So the chart of account is really very important in managing your accounting system because the chart of accounts will really generate the information that you need to better analyze and understand what's going on in your business. So the chart of accounts is really a naming convention for grouping different financial activity. And there has to be a balance between the details, very detailed for easier management, and also not being too granular as well. Just really a balance between the details and enough visibility on financial performance by product or business. So bottom line is you'll have a better understanding of where is your revenue coming from, where is your profit coming from? Where are you spending the most money? Those questions. So the chart of accounts are grouped into, of course, the two financial reports, the balance sheet and the income statement or profit and loss. So on the balance sheet, you have the assets, the liabilities, and the equity. So the assets are divided into or categorized into current assets and long-term assets. The current assets are those that are used for 1 year or less. So that would be, of course, cash or your checking account is the most liquid assets. That's your current assets, accounts receivable, and then your inventory. The long-term assets, those have a useful life of more than 1 year. And those are furniture and equipment, organization costs, building, and so forth. On the right side of your balance sheet is the liabilities and the equity. So the assets are what you own, the liabilities are what you owe, and the equity is your investment in the business. Another way to look at this is the assets are the uses of funds. So what you use to be able to generate the revenue, and the liabilities and equity are the sources of funds. Where do you get the money to purchase the assets? And that's going to be your liabilities and equity. So the liability is similar to the asset, is also categorized into two, the short-term liabilities and the long-term liabilities. So the short-term liabilities are the credit cards payable, the accounts payable, the payroll tax payable, and then the long-term liabilities are your long-term loans, like your SBA loan, if you have one, any commercial loan that you got from a lender or a bank. And then equity is your investment in the business, your capital stack, and then the earnings that you retain in the business. So that's the retained earnings. On the profit and loss, this is how it's presented. So you have the sales less cost of goods sold. Those are your direct costs in providing the product or service. So that would be your material cost and your labor cost. Total of this two will be your cost of goods sold less your sales will be your gross profit. And we normally monitor the gross margin percentage or gross profit versus over sales. So for example, if the industry average for your business is 50% gross margin, and your actual gross margin is 40%, then there's some opportunity for you to look into your business and see where you can improve in terms of either the cost management or increasing your pricing to increase your revenue here. Now for the expenses, so these are your sales, general, and admin. So it could be your salaries, benefits, bonuses, rent, legal, office expense. All those will fall under operating expenses. So you subtract your operating expenses from the gross profit. That is your operating income. And then if you have other expenses here, you subtract that to come up with the net income. And again, this is another benchmark or key performance indicators, your net income over sales. What is your profit percentage? There are three key financial reports: the profit and loss, the balance sheet, and the statement of cash flow. So the profit and loss is really managing your profit. When you're looking at your profit and loss or income statement, you're looking at the profitability of your business. When you're looking at your balance sheet, you're looking at how you're managing your wealth in the business. So your assets, how much you owe to third party, and what's your net equity in the business. So that is managing your wealth. And then the last one, the statement of cash flow, of course, that's managing cash. Cash inflow, cash outflow. Do you have normally a cash deficit or a cash surplus? So that's what you monitor on the statement of cash flow. The other question I get also from business owners is, how does the P&L or the income statement impact the balance sheet? So on your profit and loss, you have the operating profit, and that profit actually will go into your balance sheet as a retained earnings. So you can see here the importance of continuously making a profit from the business, because that will increase your equity in the business. If you continue to generate a loss, then that would reduce your equity. If you're continuously showing a profit, then that will continuously increase your equity in the business. Now, the other thing we need to look into is profit versus cash. What's the difference, right? So profit is making money. Cash is having the money, right? So you probably heard of that saying, cash is king. So this is a common comment I get. So, Christy, I have 30,000 on my P&L. Where's the money? I don't see it in my bank account. So we have to really understand that there are transactions that affects the profit, but not really the cash. So for example, revenue with credit terms. So you've recognized the revenue, but you have not collected the cash. So there is the difference between the profit there that you reported on your P&L and then the cash that you actually have in the bank. Another one is profit used to purchase inventory. So it would reduce your cash, but the profit will not be affected because you're recording it as an inventory or an asset. The third one here is capital investment. So capital investment that would show as on your balance sheet, but not necessarily recorded as a profit on your P&L. And then if you borrowed money, then you have the cash, but it's not showing on your profit and loss statement. It's showing as a liability on your balance sheet. Another one that's not on here is the owner's distribution or shareholders distribution. So you may have like a profit of 10,000, but if you withdrawn that 10,000 from the business, then you don't really have cash in the bank. Those are some of the reasons why your profit will not be equal to cash. So let's talk about analyzing your financial reports. What are your numbers telling you? And numbers can tell a lot about your business if you're closely looking at it and regularly reviewing your financials. So here is just really providing you the difference between bookkeeping and finance. So the bookkeeping is really like recording the transactions, doing all those reconciliation. But on the finance and accounting, that's where the action begins in terms of generating those financial reports, analyzing those, and making an action plan based on the things that you have identified as an area for improvements or opportunities that you can seize as a result of that analysis. So performance analysis is really very important, and it starts with really understanding the trends in your business, and then based off on that, you start establishing goals using ratio analysis and benchmarking. So this is an example of trends to watch. So here we're saying it's unhealthy because the expense is growing faster than the revenues. Over time, you will just have a negative cash flow here, and this is not sustainable. Now, the healthy version of the trend would be your revenues increasing, and probably your expense is a little bit increasing as well because of the cost of goods sold, but the other fixed costs should be just a flat over time, right? So your cost of goods sold will still be a little bit parallel to the revenue, but over time you should be able to achieve some cost efficiency on your materials and on your labor costs. So the trend should be not as high as, for example, on this one. Now, another trend to watch here. Here we're looking at the cost of goods sold here. So what's saying here is the revenue is increasing, the cost of goods sold is the same, and then the operating expense is increasing. So the healthy version of that is your revenue is increasing, your cost of goods sold is on a decline, and that is you achieve that by being more cost efficient. So for example, on your materials, over time you should be able to negotiate a better pricing or terms with your vendor, and also on your labor costs. Over time they'll be more efficient, and so that would also reduce the labor costs. And then the operating expense that are considered to be mostly fixed costs, so the should remain the same over time. Now, this is when you're comparing it with an industry benchmark. So the industry is going up and your revenue is not performing as good as the industry benchmark, so that's unhealthy. But if it's the other way around, then of course that's a better version of the trend. Now let's look at a way to analyze your financials. So on the profitability ratios, here probably the question is, what is a good number, right? In the case of profitability, of course, the higher the better, right? So your gross profit here is 50%, operating profit 20%, net profit is 15%. So when you do a comparison year by year, the trend should be going up, not going down in terms of the profitability ratios. We've done this for our clients because we have many that been with us for 5 years or more, and so we come up with a profitability analysis year by year over 5 years, and they were very pleased and really said that that's very insightful. So this is something that you're not receiving it from the firm that's handling your bookkeeping accounting, then this is something you can ask them. So this is another trend to watch, and this is more on the cash. So unhealthy is your revenue is increasing but your cash is decreasing, so more telling you that you have uncontrolled spending here. So of course the healthy is when your revenue is increasing, your cash should also be increasing. That means you are becoming profitable. So now let's talk about what are the reasons why your business is running out of cash. So first is your sales are not high enough. So you probably don't have a good sense of what your true cost is, and that is causing you to not being able to price your product or service correctly, and that affects your sales. You're not collecting your receivables and you're not charging enough to cover for your expenses, which is kind of related to number one here. And the last one here, you're spending too much money running your business. So you're not collecting money and then you're spending too much. So cash inflow is limited, but then your spending is uncontrolled or unmanageable. So, or your spending is not controlled. So that really are the reasons why your business is running out of cash. Well, some of the reasons why your business is running out of cash. So, effective cash flow management is just a couple of things to consider. So, of course, growing your revenue, the top line, that is the first thing. Know your cost and break even point. Again, going back to that cost of goods sold, gross margin, operating expenses, just making sure that you know your cost and your break even point, so you can accurately price your product or service. Bill, invoice your customer on time and then collect on time. Sometimes you would think this is just so fundamental, but there's business owners out there that they're just so busy that they're not able to do this on time, and so this is really very important because this affects your cash flow. Review your aging of receivables on a monthly basis. We have this one client where we help them in terms of really monitoring their aging of receivables and just making sure that they are following up on those unpaid invoices, unpaid receivables. And this one also takes not just reviewing your aging of receivables, but just making sure that it's maintained accurately. So you don't want to be sending a follow-up email or calling your customer when they've already paid their invoice, right? So it's also important that you make sure that your records of receivables are accurate, that you're applying the payments to the correct invoice, and then whatever is left as unpaid are the ones that you are following up with your customer. Monitor your payables also, and then use cash flow projections. So these are some of the things that we suggest to have like a process in place for your business. So when you're getting to the habit of reviewing your financials on a monthly basis, it become more natural. And the more you review your financials, the more you get familiar with it, the more you get more comfortable, and then the more you'll be able to ask more questions as you understand it better and you get more comfortable with reading your financials better. Normally, it would take 30 minutes for the review. It's a good idea to have a review. So don't take too much time. I mean, 30 minutes would be a good number to start with when analyzing and reviewing your financials. And I would suggest to have your bookkeeper or your accountant or your part-time CFO kind of helping you go through that monthly financials. And then the important thing is you analyze the data, right? And identify your big three priorities. And then share with your team, get everyone on the same page. So the benefits, you're tying your operating data to the financial data. Again, analyzing the data to find the big three priorities. So the power of three. And then that's when you can take corrective actions or seize opportunities that you see. So what are the key areas to watch for? Of course, your revenue trend. You want to make sure that your revenue trend is up, going up, not going down. Same thing with the profit growth. The higher, the better. Of course, you always want to review your COGS, just making sure that your price, that your direct cost, that you really know what your true cost is. And you need to validate that, making sure that all the direct costs are captured correctly on your financial reports. Because again, this is an important component of determining the true or the correct pricing for your business. and of course the cash trend, right? You want to make sure this is a positive trend also. So what about the revenue trend? As I said, should be going up, right? And then the business dashboard is just really like it's more like having your key performance indicators so you can measure your success, or so you know if you're making progress. So the top line, of course, your sales, your expenses, your investment, and then your equity in the business. So these are some of the indicators or checklists for success. So once taxes submitted on time, goals are set, and you're monitoring that, you're tracking it, you're monitoring your routine, the business intelligence or the financial data, those that you're comfortable sharing with your team are being shared so everybody's on the same page. If you identify any issues, then you're able to identify and take corrective action, and then you have the tools to monitor your success. So long term really is you want to have or achieve a growth, have good market position for your industry, turn on your investment and your overall equity, your liquidities, the cash. You are not having any cash flow issue, and bottom line is you can get a really good night's sleep. So again, this is Christy Fontanilla of FAS Bookkeeping and Tax Services. Thank you for watching, and I'll see you next time.